Sometimes, numbers tell stories that a quick glance might miss. Universal Robina Corporation closed 2025 with revenue climbing to 168.0 billion pesos, up 3.8% from last year. Demand for snacks and staples was steady, but beneath this headline, the company faced a more nuanced reality. Operating income slipped 3.1%, dropping to 16.13 billion pesos. Net income was down as well, landing at 10.20 billion pesos. Earnings per share fell to 4.77 pesos. For many, that's enough to signal a company under pressure, one still able to sell, but struggling to translate those sales into robust profit. Cash flow delivered the starkest evidence. Net cash from operations fell 41%, from 18.98 billion pesos down to 11.27 billion pesos. On the surface, declining profitability seems to explain the shortfall. Yet, cash was mostly withheld by working capital. Receivables shot up 8.8%, tied to higher sales and extended credit. That's revenue booked, but not yet in the bank. Meanwhile, accounts payable and accrued liabilities dropped 10.9%, meaning the company paid suppliers earlier. Trust receipts payable also fell sharply. Inventory drawdowns and supplier advances helped, but didn't offset the twin squeeze. Money in arrives slower, money out leaves faster. Cost pressures played a role too. Cost of sales rose 5%, primarily on higher coffee costs, a hit to margins. Gross margins thinned to 26.4%. Selling, distribution, and administrative expenses crept higher, with notable jumps in freight, personnel, and software expenditures. A one-off impairment loss of 707 million pesos plus a swing to net other expense further weighed on results. URC's foundation isn't broken, but this year brought unusual strain to margin discipline and cash conversion. Amid these headwinds, shareholder generosity stood out. URC declared a regular and special cash dividend totaling 4.20 pesos per share, yielding 7% at mid-April prices. That payout ratio, nearly 88% of 2025 earnings, is attractive for income seekers, but bold considering cash flow dropped so sharply. It speaks less to surplus abundance and more to confidence that 2025 was an exception, not a trend. Balance sheet metrics help contextualize this move. Debt to equity stood at a manageable 0.46x, even as net debt grew to 11.73 billion pesos. Financially, URC remains healthy, but sustainable dividends are safest when anchored in regular cash generation, not just temporary financial flexibility. If profits bounce back and working capital stabilizes, 2025's dividend will look prudent. If not, it may seem overly optimistic. The market seems unconvinced. URC shares, once as high as 156.50 pesos in 2023 and 124.40 pesos in 2024, dropped to 59.90 pesos by April 2026. At a trailing EPS of 4.77 pesos, the stock trades at about 12.6 times earnings, a fair value for a staple food giant, but not a bargain that ignores cash concerns. Investors want proof that profit can be converted to cash with greater ease. There are positive signals. International branded foods saw stronger operating profit growth. Commodities like sugar provided stability. The branded consumer food segment remains the group's core, driving over 2/3 of revenue. URC isn't distressed, it's capable, but 2025 reminded investors that margin quality and cash conversion matter most. In the end, URC sits in a complex middle ground. The dividend is tempting, valuation reasonable, and the brands are real. Yet, this year revealed something fundamental. Sales and earnings are important, but cash is the final measure. The company's next chapter depends on whether this cash squeeze passes or points to deeper inefficiency. Investors now watch with measured optimism. If URC proves its cash conversion can rebound, confidence will return. Until then, caution prevails. A reminder that in business, the numbers behind the numbers often matter most.